intention of getting this vaccine, they're sitting at 51%. So we're starting to see real deviation. And we talked a lot about the politicization of the vaccine, of COVID in general. And so much of this comes down to just people's own experiences with COVID-19 and their own worldview on medical science, and especially things, being pushed and promoted by the federal government. There's a lot of people, as many people as had COVID, there's a lot of people that really weren't impacted by it to a great extent. Those are probably the people least likely to sign up for a vaccine. And they're also the people that feel like, hey, we should be able to travel and do whatever we want right now. So you're starting to see that in the behavior. But you are starting to see also just optimism from people starting to increase in terms of how they view travel. Some people feel like, hey, later in spring, we can get moving. Summer of 2021, more and more people are starting to feel like they can move. End of 2021, a few more people. In 2022 or later, more people starting to say, hey, you know what? It's going to be safe to travel. So this will be an interesting data point to kind of monitor over time, especially as we continue to get more people vaccinated. Here is the caseload in the US for those that are opposed to the COVID vaccine. This chart's got to be kind of hurting their feelings a little bit. You can see, obviously, the cases peaking right around the time vaccines started to really roll out in early January and into mid-January. And you can see they've fallen off quite a bit. And there's really two factors that are influencing this. One, we've continually had more people with COVID, and with that comes some semblance of immunity. So people are less likely to catch it again. Some people have already been exposed, things like that. But we're also seeing this really start to showcase, I think, the benefit of the vaccine in terms of the cases are being reported. So we've seen that fall off quite significantly. And we've seen that fall off over a period in which people are actually being more active. Anecdotally, we went to North Carolina, we went to Asheville back in March. It was about 10 days after they loosened up some of their COVID protocols. They were allowing bars to stay open later, breweries could be open. The line to get into a brewery was over an hour long, just about everywhere in downtown Asheville, where they've got dozens of breweries. So people were out and about, they were doing things. We went to South Carolina this past week. My wife commented that it was really nice to be there because it felt like people weren't just worried about COVID. You were still socially distanced in restaurants. People had on masks in certain situations, but it wasn't at the forefront of the conversation. People were out and about, things were crowded. People were getting out for spring break, doing all that good stuff. So we've seen activity start to pick up and cases drop significantly. And a huge factor in that is the vaccination.
Yeah, that's a great point. I think that really is the reason that we want the vaccine and to get things back to normal and get the economy opened up again. And that is playing some dynamics in the supply chain too, though, because as demand picks up, probably faster than a lot of people had expected initially. When we think back to March and April last year, when people were talking about Great Depression, companies were hunkering down for something like that and just trying to stay alive. So they really cut down on capacity, became lean. And now all of a sudden we're having this big demand rebound and these supply chains are going to have to fire up again. And I think that was a big theme for Q1. And I think that will remain to be a big theme going forward for at least the next couple of quarters and maybe even beyond in certain pockets of the economy. So where we're seeing this more broadly is it's just taking a lot longer for supplies to get delivered. This is data taken from the ISM Manufacturing and ISM Services reports that are released every month. And it's symptomatic of what you generally see in an early stage recovery, is that as demand picks up, demand tends to lead supply at that point in time, and supply is trying to play catch up. And when supply plays catch up, it takes longer for those products to get delivered. And this is especially true on the manufacturing side, which has a longer lead time. And you generally have a little bit more of a delay as the supply chains ramp up. Bear in mind, anything above 50 here indicates that supplier deliveries are taking longer. So a reading of 76.6 is extraordinarily high historically. And you see this anecdotally as well. So what respondents are saying in this same survey is that logistics delays and uncertainty are creating significant problems with suppliers and inventories. That's in the accommodation and food services business. And there are some certain idiosyncratic factors that did play a role as well, not just the reopening of the economy. And that was there are shipping delays in the LA and Long Beach ports. There is cold weather in Texas, that winter storm there in February. And for example, in the construction industry, there's a perfect storm for building material shortages. And what a lot of these places are doing now is that there is this supply demand mismatch in a lot of, especially on the manufacturing side. And what that's giving these suppliers the opportunity is an opportunity to raise price. Because when you have a shift in supply, the natural equilibrium price goes up, you can charge more, and they're trying to lock in those prices for longer. So they're trying to get a nice pickup in price because of the change in supply and demand dynamics. You can see this further, especially if you look at the last bullet point here, where in the machinery sector, they're talking about widespread supply chain issues. Suppliers are struggling to manage demand and capacity in the face of chronic logistics and labor issues, and there is no end in sight. And so this is definitely a item that we have to watch going forward. And including in the first bullet, you can see that they're saying that suppliers are using the short-term shortage to their advantage to raise rates and raise prices. Some of the intermediate factors that we saw in the quarter included the winter storm. And this created a near-term disruption, especially in the trucking industry. You see normal load to truck ratios on this metric. These are refrigerated trucks we're talking about at this point, is 3 to 5x. We were at 15x in early March because of the backlog from the winter storm, which created incredibly tight trucking capacity. And that tight trucking capacity has actually persisted and is still today over 10, which means that we're still running at very tight trucking capacities, which means higher rates, which means more expensive ways to transport goods and more expensive costs to consumers ultimately. And you can see that here too. We're up 15% in national average rates in that lower left chart, from $2.61 to $2.99. Part of that is a pass-through of the gasoline prices, but part of that too is just incredibly tight trucking capacity, especially if you look at it in the south and east parts of the country, which was most hard hit by the winter storms. We talked about the port situation earlier. I think there's a lot of rhetoric, and when we're talking about the ports. But the point here is they're actually doing a lot more work than they normally do. In January, the U.S. imported a record amount of goods. It was actually up 9% from the prior January, which wasn't low because January 2020 was before COVID hit. But typically, that black line hovers between 10 and 20. And that's the number of ships at berth either being loaded or being unloaded. But for the last number of months, since the end of 2020, we've been hovering between 20 and 30. There's always going to be a little bit of a rise before Christmas time, but usually you don't see it in the 20 to 30 range, especially in January, February, and March. And importantly, there's a lot of ships out there waiting at anchor. So there's a lot of ships that need to be unloaded, and there's a big backlog at the ports. And so what this is again saying is that there's a lot of stress in the transportation industry right now that's resulting in higher costs, more delays to deliver goods, and that supply and demand mismatch that we've talked about earlier. Just touching quickly on the Suez Canal impact. Right now, it's looking like it's trending toward a more minor impact than initially thought when everyone was talking about it a couple weeks ago. But it just gets to the point that when you do have an issue like this and supply and demand is already stressed, one ship getting blocked in the Suez Canal, which 14% of global trade goes through, that's going to cause a big disruption that certainly causes a lot of headlines. So it's a symptom of what we're seeing. It's not necessarily a cause of what we're seeing on the supply chain side. More granularly, what we're seeing in the semiconductor world is that we're seeing significantly longer lead times. In fact, longest lead times for semiconductors that we've ever seen. Now, this is pretty important because semiconductors now go into a lot of different things, not just your smartphone, they're going into automobiles. You can't manufacture a car if you can't get the chips. So what happens is a lot of car manufacturers will pull production, which means that there's less economic opportunity to actually produce those cars. So getting those semiconductors and getting those raw materials essentially for building and producing some of these more complex pieces of machinery is a key element going forward. And that is where we do see the shortages, is in a lot of those power management and analog devices, which go into automobiles or factory automation equipment. And that's where we're seeing the biggest stress. And what caused this is in 2018, we had a very strong market in semiconductors, a lot of demand, and chip manufacturers were having a very good period, but that really faded away significantly in 2019. And the nature of the semiconductor industry is it's extremely cyclical and very capital intensive, which means they're extremely scared of overproducing, because the nature of the industry means that you have to produce at full capacity in order to get leverage on your fixed costs. What that means is that firms are extremely reluctant to reduce production, and it can really result in a death spiral if you're producing too much. So these companies have kind of understood that now. And so 2018, they were producing too much. There was probably a little bit too much capacity, so they pulled back pretty dramatically. They were ready to hunker down for a little bit of a weak market in semiconductors. So they pulled back on capacity expansions. They pulled back on new factories just in time for one of the biggest demand shocks in a work from home environment in early 2020. And so you basically caught the entire semiconductor world sleeping at the switch. And so you had demand ramp up and semiconductor supply still relatively low. And as you can see, semiconductor shipments have now increased, but it's meaning that these factories are working overtime. They're running at over 100% capacity, and they're now spending a lot of money to play catch up. Problem with the semiconductor industry is this is an area where it does take a lot of time to ramp up production. Taiwan Semiconductor CEO actually wrote a letter to his customers at the end of last month saying that we've been running our factories at over 100% utilization over the past 12 months and still not been able to keep up with demand. Taiwan Semiconductor is one of the largest semiconductor manufacturers in the world, and they cannot keep up with demand. In fact, in semiconductors, usually reduce prices every single year. That's just kind of how technology works. As time goes on, technology gets cheaper. They've actually already said no price cuts in 2022. And part of that is because they're ramping up production, and it's going to take time to ramp up production. It's going to take a few years. And so when we talk about supply catching up to demand in semiconductors, this is not probably going to be a 2021 phenomenon. It's probably going to be late 2022 or even 2023 before supply and demand can come back into a normalized balance. That's having implications, again, across industries. In the automobile sector, for instance, you have production which basically got turned off last spring, even though there was still some demand, even though it was lower than normal. And production came back fairly strong over the summer months, but now that we have that blue line shows current state of production, now that we're having those semiconductor shortages, you're again seeing that manifest itself in a shortage of production in cars. And that means, again, we have a supply and demand mismatch, this not in semiconductors this time, but this time in cars, which means this is why used car prices are going up. This is why new car prices are still very strong. And that's because we have that supply demand mismatch. Houses don't use semiconductors, but they still have extremely high degrees of supply-demand imbalances right now. Right now, the month of supply is down to 1.5 compared to 3.1 last year. Home inventory is down almost 50% versus this time last year. 50% is a lot of percent, and it means that supply is extremely low, even while demand is elevated. You're seeing 35% of homes that are sold above list price in the United States. The average sale to list price in the United States over the last 4 weeks has been 100.5%. So if you list your house for $300,000, the average would say you're going to sell that house for $301,000. And if you look at the chart on the right, what you can see is even with inventory down 50%, sales are still up 19%. So when you have such a tension like that, you're going to have higher home prices, and this is what we're seeing. So switching gears or moving on to a little bit more on household formation is, why are people buying so many of these houses? Because we were just talking about the baby bust last quarter. The baby bust is something that the Brookings Institute started talking about last summer as a result of COVID. And it's definitely happened, especially, and it's not just isolated to the United States. France is down almost 15% in terms of new births. Hungary is down a lot. Japan is down almost 10%. But it's not really a surprise. We knew about this last summer. And so what we want to look at is not the trees, but again, we want to look at the forest in this presentation. And so for that, let's turn to US demographics. And the US demographics is actually pretty attractive right now. This is the first time for a number of years where the age of 30 to 34-year-old males is, there's a higher percentage of those than 25 to 29-year-olds. That's important because the average age of marriage in the United States for a man at his first marriage is 30.5. And obviously there's a lot that comes with that, including buying a home, having children, having that demand impact that's associated with buying children and having a home and furnishing the home and buying things for the kids. And so that's a huge demand driver. And if you look historically, what you can see is the dates on the x-axis, periods of fairly reasonably robust economic growth and stable economic growth tend to coincide with periods of stable age of marriage. When the age of marriage is falling, it tends to mean that people might be overextended a little bit, might be buying a house a little bit too early. And then when the age of marriage is rising, people are deleveraging. This is when they have that deflationary impact. This is what we saw potentially in that in the 2008 to 2012 timeframe. This is what we saw indeed before 1982 as well. And over the last 4 years, we did start to see some stabilization here. We started to see a little bit more productivity. We started to see broadening out of the middle class. And then we had the COVID shock. And no one got married. There was no household formation. I would actually expect that to reverse in 2021. And I would then expect this stabilization trend to continue and may even accelerate due to the higher savings that millennials have amassed over the last few years. Because a recent survey did show that millennials are catching up to their parents' wealth. So just zero in on this 1980 to 1989 cohort. These are people who were born between the years of 1980 and 1989, and their wealth is compared to their parents' wealth at the same age. So in 2013, these people, these millennials, had half the wealth that their parents had at the same age. It's pretty hard to start a family and buy a house and have kids when you have half the wealth that your parents did. And even in 2016, they only had 60% of the wealth their parents had. In 2019, that was getting a little bit better. They had 89% of the wealth. And so we're starting to see a little bit more momentum in household formation. That's a huge driver of economic activity as we go forward. Furthermore, the COVID impact actually increased a lot of the savings, not just for millennials, but across the board. The average savings rate increased to 15% in 2020. We're Americans. We're not supposed to save much at all, let alone 15%, especially in a recession. And so personal savings was $2.85 trillion in 2020. That compares to GDP that's only $21 trillion. So we saved a lot of money in 2020, and that can be deployed relatively quickly. Thought about another way, this works out to savings for every man, woman, and child in the United States, rising to $8,636 from $3,727 in a single year. So that's in a recession. You more than double the savings rate of the average American. And so not surprisingly, this is resulting in an acceleration of home building. We have a shortage of houses, so you build homes. And Lennar and KB Home all speak to this in their recent earnings reports. Lennar talking about low interest rates, personal savings rates, very strong during the pandemic, strong government stimulus, and household formation as well. In fact, Lennar actually said, kind of tongue in cheek, we could actually have sales be whatever we want them to be. The market was just extremely strong, and there wasn't even one place that they especially call out. They just said it's broad-based. And then KB Home actually keyed on the same demographics that we're talking about, and they say that these underlying trends mean that demand will stay healthy for the foreseeable future. As a result, we're looking at a record year of new home builds. The previous record was 2005, which saw roughly 1.3 million new units sold. Right now, we're looking at 1.5 million. And I mean, Lennar is saying that they could have sales be whatever they want them to be. 1.5 million might be conservative. And you can see how those expectations have already ratcheted up significantly just in the last 6 months. And then, of course, no economic presentation is really complete without a quick brief on unemployment and inflation. And then we'll talk a little bit about the Federal Reserve. And on the unemployment side, things are brightening a little bit too. We had a little bit of a pause out in the winter, November, December, and January, but things have accelerated and picked up once again. And we had a really good, strong jobs report in March, and you can see that green line, that green bar growing nicely as employment and hiring reaccelerates. Importantly, this is not only because there are not very many jobs available. It is also because people just are not interested in working again. Right now, we have 7.4 million job openings nationally, which is as many as we had before the pandemic. There are a lot of job openings in healthcare. That's accelerated substantially. And there's a lot of job openings in arts and entertainment. That's accelerated significantly, even from February 2020. So this suggests that the strong employment numbers that we're seeing, it's not just a one-time phenomenon. There are jobs out there. There's going to be hiring that continues, and employment numbers should continue to improve nicely. In fact, small businesses are actually even a little bit concerned that they can't get employees. They're talking about employees not really wanting to work because they're scared of COVID. Large companies like Amazon taking some workers away from them. Potential competition from the enhanced unemployment benefits that were recently passed. And then just energy levels. People are not used to working 9-to-5 jobs anymore. So there's definitely that aspect as well. And in fact, approaching 50% of small businesses are saying that they have job openings that they can't fill in March. So all this leads into, well, with all the supply and demand imbalances, are we seeing inflation? And the question and the answer really is, we are seeing inflation, certainly right now. The question is, will it be sustained? But right now, what we're seeing is, as we talked about earlier, Taiwan Semiconductor suspending wafer price reductions for 2022. They're increasing tanker rates for transporting petroleum products. And then, interestingly, Kimberly-Clark is increasing net sales prices across its North American consumer products business in the mid to high single digits. I mean, when was the last time that we had 8% increase in price on toilet paper? And then Belarusian Potash also had just negotiated a deal with India on selling potash to them in January. And they renegotiated that deal in April, 13% higher. So we're seeing price increases and we're seeing inflation across the board, across industries, across verticals. And I think that's definitely going to manifest itself in higher inflation numbers. The question is, do we then subsequently see this continue next year with more inflation increases and the following year? And Tom will talk a little bit about that and prognosticate on that.
Hey everybody, let's talk about the Fed. So what we've got here on the screen is what they call the 5-year break evens, and this is the measure that the Fed puts out, which is their best estimation of what the average inflation rate is going to be over the next 5 years. And you can see we've had a really sharp increase to start the year, and that's caused a number of headlines really through the first quarter, and a lot of that had to do with Treasury yields ticking up. And so you can see, I mean, if you look back, we're basically at the highest level since 2014, and inflation has been pretty steadily held underneath 2% on average, really for the last 10 years. Or we've had unbelievably low inflation for a long time, and the Fed is hell bent on changing that. And we'll go through that over here in the next couple slides. So here we have is the inflation numbers as put out as projections by the Fed. And you can see that they've steadily increased that number in 2021. Curiously, though, they are expecting to keep interest rates at 0 until at least 2024. And this is confusing the markets. But this is basically what the Fed wants. They believe that they're only going to get credibility on inflation if they let inflation expectations run hot. And so their mandate really up until about 6 months ago was that they wanted to see 2% inflation and not really see it exceed that or go too hot or really drop too far below that. They were really shooting for 2%. And they've changed that and finessed that goal a little bit over the last 6 months, which is that they want to have an average of 2% over the long haul, which means because we've been so far under 2% for so long, they're going to want to let it run hot, which means that they're looking for elevated inflation going forward. And by keeping rates low, they're probably going to achieve that sooner rather than later. And here we have the very old picture of Jay Powell. He's looking very young and handsome in this picture. He doesn't look like that now. He's very stressed, I'm sure. But essentially, the Fed, their opinion on the inflation that we're seeing that Ben talked about with potash and chips and really everything across the board is that they're saying it's transitory, which is essentially, you know, we're seeing a lot of inflation in a lot of different pockets, but that it's going to be short-lived. And the reason for that is a supply-demand imbalance, which is essentially the entire economy went into hibernation back in March. There wasn't a ton of demand, and then suddenly everything's reopening. Everybody wants to consume, they want to buy, and it's causing shortages, and as a result, prices are rising. And so what they want to do is essentially create a paradigm shift that makes consumers want to consume today because prices will be higher tomorrow. And Jay Powell has been on the record as saying that even in the last week that he would be comfortable letting inflation run to as high as 4%, which historically speaking is an exceptionally high level. But in order to get up above that 2% on average level, and so while there has been a lot of talk about, man, rates are really going to rise, we're seeing a ton of inflation all across the board, he thinks that's going to be short-lived, and the Fed is going to have to keep rates low in order to continue to drive that inflation going forward. And so here we have what they have listed as their criteria for liftoff, which is what needs to happen in order for the Fed to raise rates. And the first is for the labor market to be consistent with maximum employment. And really up until COVID, that meant the raw unemployment number, which is, you know, they want to be as low as possible. They want everybody working. And while the number has come down, you know, Ben went over the slides, we've seen a ton of jobs come back. there's been a huge imbalance on who's come back to work and who has not. And so, basically the upper 80% of the labor market is back to work. Blue collar job or white collar jobs, people who are working at home, they never really left. But a lot of the lower end workforce has been left behind, and that includes a lot of racial inequity. It includes a lot of women who have left the workforce to stay at home and take care of children. And so what they want to see is not only a low unemployment number, but the bottom rungs normalize. And so, I mean, we've seen numbers as high as 17% in the lower quintile of the employment sector. And so they want to see that come up before they really make any major changes. And that includes increasing the participation rate, which would be, people who have left the workforce to stay at home, or people who have left the workforce because they're afraid to go back for COVID. Those people need to return to that workforce and become employed before the Fed sees fit to raise rates. The second would be what we talked about. Inflation needs to be at 2%, if not exceeding 2%, for the time being. And then I guess the third point would be they need to moderately exceed. They need that inflation to get up, stay up, and bring the average back up, because we've seen such low inflation for such a long time that they need this economy to run hot, to essentially burn off the scars of COVID.
So you pull that all together, and what you have is, in the short term, we have significant supply and demand imbalances. There's really, really good demand in the economy. There's healthy, very high amount of inflation right now that's likely to actually result probably in a permanent step up in price levels. Question is, how does this evolve over the medium term, especially on the inflation side? Does it continue to increase like this every single year, or do we basically stabilize at this rate? So that's a key question mark going forward. And then over the long term, I do think that millennial household formation is going to be a story to watch. But right now, the big story is we're seeing pretty good demand that's likely to continue for a number of quarters. We saw those large savings rates, and a supply chain that's still struggling to catch up, and will probably take at least a few quarters to catch up, and in some sectors, probably even longer than that. So that's what we're looking at right now on the economic side. So broadly optimistic, but there are some concerns, and we are watching the inflation fairly closely as well. On the market side, this is a pretty famous scene. The Duke brothers were, from Trading Places, involved in a scheme to buy a lot of frozen concentrated orange juice and corner the market on that. Well, they tried to do that, and ultimately it went down, and then it went down further and further and further, and they ended up panicking and selling everything. And that's what it felt like it's to some extent in bond world over the last quarter. As interest rates started to go up, they went up slowly, and then faster and faster and faster. And this kind of makes sense. Late last year, early last year, bonds were a great safe haven. This is where a lot of money was flowing because people wanted to get out of the stock market and into safety. And then what happened is, as 2021 began and the economic outlook brightened and people got a little bit more concerned about interest rate increases, they started to sell bonds, and everyone who bought bonds last year all of a sudden saw their positions turning south and had to get out. So when Jay Powell was asked about, is he concerned about the rapid rise in interest rates, he kind of gave a non-committal answer, and so that one is displayed there. So Tom, talk more about bonds.
All right, let's talk about bonds. So the chart we're looking at here is called the dot plot, and it comes out every time the Fed releases their minutes. And essentially what it shows is what we talked about, which is their plan for liftoff. And each dot represents one of the voting members of the Fed and where they estimate the Fed funds rate will be in a given time period. And so you can see here, without a lot of dissenters, everybody seems to think that for the most part, we aren't going to see a raise in the interest rate environment until 2024. And the Fed has been extraordinarily firm on that. But why is this important? essentially, when the Fed sets interest rates at zero, all other bonds are then, basically adjusted from that point. So the Fed funds rate is how much banks charge each other for overnight lending in order to cover reserves, and then every other, benchmark for lending is then pegged to that. So if you think of prime, which is used a lot for credit cards and things like that, prime is typically 3% over the Fed fund rate. So right now it's somewhere between 3 and 3.25, depending on what bank you're looking at. And so it kind of sets the tone for the lowest end of lending, and then all other bonds are stacked on top of that. And so by indicating that they're going to maintain zero interest rate policy, or ZIRP as they call it, they're signaling to the greater economy that money will be cheap and free flowing, and that companies are going to be able to refinance debt or take out new debt at extraordinarily low levels. And that really feeds a lot of energy into the economy, because basically companies can either expand, they can go out and plant more corn, go out and mine more coal, they can go out and grow more corn, because they can get access to easy free flowing money. And that really resonates not only with companies, but with people and across the board. And so one of the negative side effects of that is something we've talked about a lot on the morning calls, which is zombie companies, which essentially is with super low rates, companies that otherwise would not have easy access to capital would have to be borrowing at extraordinarily high rates in order to stay afloat, can participate in this as well. And they can refinance their debt at lower and lower levels and kind of kick the can down the road and continue to operate. And so when you see a reversal on that, a lot of times you'll see companies blow up because they're no longer having access to that easy capital, and bankruptcies can be a real negative externality there, but it's going to be a few years before we see that. So this next chart is a side-by-side comparison of the yield curve on 2/19/20 versus 2/19/19. And you can see here really the effects of the Fed raising rates. So when the Fed was hiking rates slowly over the last year or so, you can see that the front end of the curve came up, right? Because if the Fed funds rate is over 1%, then you're essentially saying 1 month borrowing is going to be pegged to that. And so we saw an inversion on the yield curve there as the rate at which the Fed was hiking rates was faster than the market at large was really digesting that information. And so you can see that when it cut rates to zero, the front end of the curve dropped. And long end is more market driven, which is to say that people buy and sell bonds based on how much they want to be compensated and for how much risk. And so at the time with the Fed raising rates, why would you lock into a 30-year bond? You can see here on the chart that a 30-year bond was essentially paying you 2% when a 1 month bond was paying you more than 1.5%. And so that's a market driven cycle, right? Because people aren't going to buy those bonds. There's less demand for them. And so you're basically pushing all the demand towards the front end of the curve. We're seeing the opposite now, which is that they've cut rates to zero. And so now that people think that, it's a fair compensation to lock in for 2% for 30 years, because on a 1 month bond, you're essentially getting paid zero. And what are long-term rates? Why are they important? Because if you think of the bond market as a layer cake, and each successive layer is more risky than the last, the treasury curve is essentially the bottom layer of the cake. And as it moves up, so do all the other layers. Each successive layer, you get more and more yield the further you go out on the credit curve. And so, with the rates rising on the long end, you're seeing a lot of pain in those successive layers, because as the yields go up, the prices go down. And so things like corporates, asset-backed securities, they've all seen a lot of pain to start the year. And the more and more rates rise, the more and more pain you're going to see in the bond market. And so that's really the fear there, is that as those rates go up, so too do the borrowing costs for those individuals or companies that are trying to get into bonds. And so that's really the fear. It causes people to worry that, hey, we either need to take this debt out now, or we're going to end up in a situation where we can't borrow at these costs. And so that's essentially what we're seeing in the bond market to start the year. So here's an example of where the Fed is also acting. And so traditionally, when you see a spike in the 30-year Treasury, which is what's really the driver of the 30-year mortgage, is usually you see them moving pretty much in lockstep. So as 30-year Treasury rises, so too does the 30-year mortgage rate. But what you can see here that the Fed is acting very heavily. It's the the spread between the 30-year and the 30-year mortgage is actually extraordinarily tight right now, and it has not moved up as much as it would have historically. And the reason for that is the Fed is actively buying mortgage-backed securities and bringing artificial demand into the market. And so as a result, while the 30-year Treasury has sold off significantly, the 30-year mortgage is still at a relatively low rate. And that's because they're driving demand. They're trying to keep that down because the lower the 30-year mortgage is, the more people are going to be buying houses. And the more people buy houses, the stronger the economy is. You know, there's just a number of factors. And Ben talked about it a lot earlier, which is if you buy a house, you're probably going to Home Depot all the time. You're probably buying furniture. You're probably having kids. And so by keeping those rates low, they're able to manipulate the market outside of the Fed funds rate, and they can actually drive more economic activity by basically printing money and using that money to buy mortgages. And here we can see a chart that shows the performance of muni bonds versus the bond market at large. And so we talked a lot in our Q4 macro about why we were targeting munis specifically at the end of the year versus things like corporates and asset-backed securities, which we talked about had a really tough time to start the year. And the reason for that is they operate a little bit differently in terms of their structure and the amount of issuance we've seen this year. And so at the end of 2020, the bond market had exploded in terms of size. We saw all-time records for corporate issuance. We saw all-time records for treasury issuance. Mortgage backs were exploding. There was just new debt everywhere. And so the market was expanding rapidly. But what we didn't see was muni bonds expanding. In fact, the total issuance of municipal bonds year over year was roughly flat. And within that, there were more taxable municipal bonds issued, and the amount of tax-free municipal bonds that were issued has actually contracted. And so that's the area of the market that we were most interested in, because there are really three main things that drive that. The first being scarcity. You know, there are less bonds to be had, and we have a lot of relationships around the market where we can find those bonds and we can find them at better prices. The second would be relative value. You know, we talked a lot about where treasuries are. You can actually buy most munis, you know, outside of 5 years at a positive spread to treasuries, which means you're getting more yield compared to a treasury. And in terms of credit quality, you're only taking a little bit of a step down because municipal bonds, really second to treasuries, have the lowest default rate among all bonds. And then the third piece of that would be the tax exempt status, which is, you know, even if you're getting, say you buy a 10-year bond and it's paying you 1.2% and the 10-year treasury is at 1%, you're still not paying taxes on that. So depending on your tax rate, that could really accentuate the total return of your bond because you're not paying federal taxes on those. And you can see here how that played out for us, which is if you look across the book, we probably have 95% of our bonds are tax-free or taxable municipal bonds. And to begin the year, the first quarter, they were down 0.35%, whereas the bond market at large, which the Barclays Ag is mostly treasuries, asset backs, and corporate bonds, were down 3.28%. So that's a wide margin in terms of performance. And additionally, you know, going forward, we actually are starting to, you know, dip our toe into, you know, some corporates and some asset-backed securities that we're looking at opportunities there, because for the first time, really in a year or two, we're seeing where this drop in prices is creating opportunities where we think that the risk-reward seesaw is essentially tipped in our favor for the first time in a while. And so we avoided those like the plague last year and really through the first quarter of this year, because with rising rates and increased inflation, those bonds were definitely due for a haircut. And so now that haircut has occurred, we will be definitely looking for opportunities here over the next quarter or two to dip our toe there. So finally, the last slide really is to talk about what's going to continue to drive interest rates higher. And there are a couple of headlines that have been thrown around, and we're just kind of going to rank them in terms of the most likely to the least likely. And the first would be a debt downgrade. If you think back to 2011, there was a debt downgrade, which essentially was the U.S. was AAA. They were the highest credit quality bonds in the world, and they were downgraded to AA1. And that caused some roils in the bond market for a short period of time. And we don't think that's extraordinarily likely. The way the Treasury maturity schedule is structured, we've had so much new issuance in the last couple of years in the lowest interest rate environment in history And so as old bonds are rolling off, we're actually seeing a drop in the interest rate expense, which is that old bonds that were issued at 2%, 3% are rolling off, and new bonds that they've issued in the last few years were issued at 0.5%, less than 1%. And so it's actually, in terms of the interest rate expense in the short term, provided rates don't continue to spike, we've actually seen a drop in the interest expense. And so the U.S. is actually in a better position debt-wise, having more debt than you would think. So we view that as particularly unlikely. The second would be, we continue to see just extraordinary growth in the economy. We continue to see the Fed get pressured to basically expose their hand and say, hey, we actually have to raise rates sooner rather than later. I don't see that as being a near-term possibility, but I think in the medium term that could happen if we really see this economy take off. We really see things open up, everybody gets vaccinated, and life returns to normal. I think we could really see this thing rocket off. And in that case, I think we would see the liftoff on the Fed's fund rate be accelerated forward into 2022 or 2023. But given the steadfast nature of the Fed and how they're saying, no matter what, we're not even thinking about raising rates. I think that in the near term, that's very unlikely. In the midterm, it could be a possibility, but probably also unlikely. The third would be we see inflation continue to just to ramp up. And I think that one is actually more possible than not. Depending on the different indicators you look at, I think the Fed is underestimating the amount of inflation and the transitory nature, which they seem to be really pegging to, these prices aren't going to stick around for a long time. I think that is potentially a pitfall. I think that some of these price increases are going to continue, and especially if we do see that growth, I think they might stick around for a while. And so I think that is a more likely scenario than not. And then, of course, finally is supply and demand. We've talked a lot about it on our morning calls, which is that we've just seen unbelievable issuance on treasuries, and someone's got to buy those bonds. And so there's been a couple of stumbling blocks this year. The 7-year treasury has been the one that has had the most trouble. And each time we see a bond auction go off at the treasury that is not strong, they don't see a ton of demand, we've seen a real adverse reaction in rates. We've seen rates tick up significantly. In fact, this afternoon, we actually had the 30-year bond auction that was very, very strong, and it sent rates, plummeting for the day. We're at the lows of the day at the close, and the market, of course, took off because some of these fears were allayed by that auction. But there's new auctions every week. We're issuing $360 billion in new treasuries over the next 2 weeks, which is enough money just to buy Walmart outright. And so we're going to have enough supply and demand to keep rates. We have to have enough demand for the supply in order to keep rates low. And I think that that's probably the most likely scenario, is that the issuance is going to spiral out of control, and there just aren't going to be enough people who want to buy these bonds at these prices.
All right, Tom, thank you. And I think the interest rate issue is definitely applicable as we transition now to talking about stocks, because that definitely played a big role in discounting some of those growth stocks in the first quarter. And we've talked about it for a long time about how growth has continued to outperform value. So the growth is the orange line here, the value is the green line. It's hard to pick out too many points where value outperforms growth, except here in Q1 2021, where you really had a little bit of revenge of value, up 10.8%, and S&P growth up 2.1%. The overall market performed well, up 6.1%, a very good quarter in isolation. I mean, that annualizes out very strongly, close to 30%. So a good start to the year in the markets. And as fund managers are wont to do, they like what's been performing well. So whereas last year, fund managers tend to want growth, now that they all want value. And in fact, it's the most on record that fund managers are betting that value is going to be outperformed going forward. And this was from a Bank of America survey in mid-March. So Sam can talk a little bit more about the difference between the two here.
Thanks, Ben. Yeah, so basically at the most elementary level, that process is that value outperforms in down markets while growth outperforms in up markets. But as you could see on the earlier slide, sometimes value outperforms, sometimes growth outperforms. And so as such, we think it's important to understand the characteristics of each of these classifications. And at that point, we can basically look for stocks that exhibit the best of both worlds. That'll help us try to achieve, some of the potential upsides associated with growth stocks, while helping protect our portfolios in the downside with an allocation to value stocks. And so as you can see on this slide, these are the formal definitions of growth and value that are used to make the S&P Value Index, the S&P Growth Index. So this comes from the S&P Dow Jones. And so basically, it's what you'd expect for the growth companies, looking for high growth in earnings per share, as well as high growth in the sales per share on a 3-year basis. But also, it's simply just momentum. How much has the price gone up over the last 12 months? And so while growth is always viewed favorably, just the price running up over the last 12 months is hardly a reason to buy a stock. And a good example of this is GameStop. We all know about their short squeeze at the beginning of the year, ran up a ton due to nothing, not due to any changing fundamentals. So it's not a good reason to buy. You could have gotten burned on GameStop if you bought it at the wrong time. On the other hand, we have value. Again, pretty straightforward, associated with the low price to book ratio, low earnings to price ratio, and a low sales to price ratio. And while cheap valuations are preferred, these often come at the cost of no growth. And then sometimes these companies will trade at a depressed multiple for a reason, again, such as GameStop before the short squeeze. So lastly, for the Dow Jones, in terms of the index construction, basically they just they'll take the S&P 500 companies, they'll rank them all from the most growthy to the least growthy. And then basically the top third will be ranked as pure growth, the bottom third will be ranked as pure value, and then that middle third will be ranked as a blended category. And so moving on, basically it's to think about how this actually shows up in stock prices. Ben thought it was a good idea to take this through a picture from the movie The Intern. For those of you who haven't seen it, Robert De Niro plays the role of basically a dinosaur who's past his prime, but he's a good employee. He's always there. He does the right things. On the other hand, you have Anne Hathaway, who plays the role of a successful businesswoman. She's on the up and up, a lot of potential in her future. And so that's a good way to think about the value and growth stocks. So value companies, typically companies that are past their prime, but they're well established. Due to the lack of growth, these companies typically trade at cheaper valuations when compared to growth companies. They also have a steady stream of predictable cash flows, which allows them to return cash to shareholders through dividends and repurchases. On the other hand, we have growth stocks. They'll typically trade at more expensive valuations on the hopes of future cash flow streams. And then just to piggyback on Tom talking about rising inflation and rising interest rates, this is one of the large reasons why growth underperformed in the first quarter of this year. These higher interest rates basically raise the discount rate. And since their cash flows are further out in the future, we have to discount those rates at a higher rate, which actually pushes down their share price. And then finally, since these companies are still growing, they're not paying dividends, they're just reinvesting their cash. Since the best is yet to come for these guys, they want to plow their money in while they can. So I think it's pretty clear that being entirely growth or value isn't the right answer. So at Gnarl, we try to look for the best of both worlds while trying to find hidden value in growth stocks to try to supplement some of the upside. And so a good example of this is Amazon. Amazon, they're a typical growth company, high PE, high price to book, all the works of a growth company. But I like to think of, if you take their price to book, which is currently elevated at 18.3. And so if we were to assume that a company was actually able to buy Amazon and Jeff Bezos came with them, Jeff Bezos was going to run the new company, you got the Amazon brand, how much would somebody pay for Jeff Bezos to run that company? Or how much would they pay for the Amazon brand? And the answer is they'd probably pay a lot more than what traditional valuation metrics would say that Amazon is worth. And then that extra price that they pay is actually going to get wrapped up into the goodwill line item on the balance sheet. And so this new company, which is going to be predominantly Amazon, since Amazon's so large, all of a sudden this new Amazon company has a lower price to book ratio because that goodwill line item just goes way up. Price to book comes down. All of a sudden, Amazon looks like a little bit more like a value company versus a growth company. But however, since Jeff Bezos and Amazon, they built the brand and that leadership, they built it organically. They don't get to add that into goodwill. They don't get to add their value back into their book value. So they continue to trade at a high price to book. And the next, GameStop, we all know that they benefited from the short squeeze. It's a little bit confusing here, but they're a traditional value company. They trade at a depressed PE because they operate in a dying business, brick and mortar gaming. They're not online, not a good spot to be in. And then all of a sudden they have the short squeeze, the price runs way up. But as we said earlier, price momentum is hardly a reason to jump in and buy a company. And so really I mentioned GameStop here mostly to say that the label of value versus growth is almost meaningless. Basically what we want to focus on are what characteristics are desirable of growth versus characteristics that are desirable of value, put them together. And that's how we want to build our portfolios. And so on the next slide over here, we can see this is a typical portfolio at Narwhal. And so as you can see, we've really done a good job of focusing on this blended category, which in our opinion is the best of both worlds. We're capturing some growth at a reasonable price, reasonable valuations. They have, future prospects. They're not in a dying business. And then we supplement that with some of these kind of hidden value growth plays such as Amazon or Alphabet to try to supplement some of the upside. But then we have a heavy leaning on value to try to help protect our stocks in the downside.
Great, thanks, Sam. So I think the big takeaways from the market's perspective is, look, interest rates are up, but they still remain historically low, historically low. Value stocks have improved versus last year, but they've retraced some of the gains of the losses that they made last year versus growth stocks. Sentiment is up, but it's not extreme right here, and we'll talk a little bit more about that in a minute. So, when we look back at Q1, I think we could mistake the trees for the forest a little bit because we'd be seeing, value stocks, that's the only place to be. You have to be out of bonds. Sentiment is extremely elevated. Look, the market was up 6.2%. That's partly true, but it's not the big picture. So I think it's important to keep in mind that big picture when we're talking about the markets. Last section here, and this one will go pretty quick, is the decision makers. I think Annie Duke's been in the press a lot lately. She was a former poker player, now does a lot of consulting for financial firms. She says anyone blaming others for their bad results and failing to give them credit for their good ones is under the influence of ego. So I think that's something that we can all keep in mind, especially as we evaluate ourselves and then as we evaluate others as well. So beginning with politics, who's a great one to blame, we have the American Jobs Plan. This is the big infrastructure bill that was unveiled a couple weeks ago. I think the big takeaway here, you guys have all seen the headlines. The big takeaway is that this was all in his campaign. He says the corporate tax rate is negotiable, but this is not a surprise. And from a market's perspective, as long as there aren't surprises, people are generally happy with that. But again, this is a priority on the infrastructure side. In the next week or two, we will be getting more details on the American Families Plan. And if President Biden's campaign promises are anything to go off of, this is something, some of the things that we'll be looking at: more access to childcare, more incentives for unionization, universal preschool, and higher capital gains rates at a top tier rate. So these are some of the things that I think are probably likely in the American Families Plan. And then there weren't any surprises in the American Jobs Plan, really. So I wouldn't really expect the American Families Plan to deviate too much from this list. In terms of corporate America, there's a lot of momentum going on. Nike used momentum a lot in their conference call just a few weeks ago. They said, so for color, they expect to be up 75 to 100% this quarter. Now, it's a really easy comparison period, but they also expect momentum to continue to result in strong fiscal year 22 revenue growth, which doesn't end until May 2022. So just for perspective, taking a step back here, this time last year, companies were hesitant to give guidance for the month. Now they're giving guidance for more than a full year from now. So this is just a change in the optimism, dramatic sea change in the optimism levels from companies. Jamie Dimon, who's very well respected on Wall Street, saying that this Goldilocks moment could last through 2023 in a letter that he wrote last week. And interestingly, a lot of corporate America is playing the politics, and Jamie Dimon is no exception. He does say, you know, we could see individual tax rates go higher for the wealthy, and he'd be okay with that, so long as there are specific mechanisms to measure whatever the government does with that money. So he doesn't want to just the tax rates to go up and then money just gets dished out to nowhere. So he wants clear, identifiable areas where that money is going. So that's an interesting view from JP Morgan, but overall his view on the economy, fairly optimistic. GM, which is struggling with all those semiconductor shortages, say that they still feel comfortable with this full year guidance and that it's going to be a really strong quarter. And I said that just a couple of weeks ago. So this is a really good news from a company that's actually been in the epicenter of some of these issues, supply chain issues that we've been talking about. In aggregate, we're seeing a lot of mergers and acquisition activity. We're seeing multi-billion-dollar deals between companies. You had the AerCap GE Aviation deal where they bought more planes from GE Aviation. Canadian Pacific, Kansas City Southern, a merger of two railroads that was really forward-looking. And Chubb made overtures at Hartford Insurance, which would have been a $23 billion acquisition. Hartford actually rejected that deal, but something tells me Chubb will be back, whether it's Hartford or someone else. That's just kind of their MO. But lots and lots of mergers activity in the quarter, which is a good signal. It shows that there's confidence in the C-suite. And when you couple that with the early stage expansion, I think that this bodes fairly well going forward. If you look at the proportion of CEOs projecting hiring increases over the next 12 months, that's at very good levels, even higher than February of last year, which was again before the pandemic really hit the United States. And CEO business confidence for 12 months out is quite strong. On the investor side, you see a healthy optimism, but not excessive optimism. So we're at about 7.2 on the Bank of America indicator. This has been remarkably tight the entire year. It's been about between 7.0 and 7.3 the entire year. But importantly, we actually have seen a decline in some of these meme stocks, and that's the right-hand chart that you see on your screen. So overall, I think we see a balanced, optimistic view of the economy, which is probably appropriate at this point in time. So you put that all together and what do you get? First of all, the economy is reaccelerating after a bit of a pause in the winter months. We see really good momentum in jobs, which I expect to be sustained. We see all those job openings, and I think that will lead to healthy job and employment growth over the balance of the year and perhaps beyond. You also have bullish sentiment among business leaders. They're looking to hire, they're looking to expand, they're looking to merge. You do have some elevated sentiment, but it's not extreme. So that's something to watch, but not be overly concerned by or be myopically focused on to the detriment of actually deploying capital. And then long term, so midterm, there's a little bit of uncertainty. What's inflation going to do? How is growth going to change as we digest the lack of stimulus, relative lack of stimulus in 2022? But long term, you do have that demographic underpinnings that I think could really be that rising tide. So whereas you might have waves that crash along the beach, you come back in 6 hours and the tide is higher. So that might be something that we need to watch out for on the demographic side that could really result. And keys to watch there will be the household formation, the home purchases, and all those trends continuing. And like I said before, inflation does remain a bit of a question mark. We're going to see a big step up in price increases over the next 6 months or so, maybe even 6 to 12 months. The question is, does that inflation actually persist beyond that? So those are the big takeaways from the economy and the markets. Overall optimistic view. There are some uncertainties on the medium term. Long term is supplemented by some of those demographics, and short term we have those big supply and demand imbalances because we have really good demand and the supply chain is still ramping up to catch up. With that, Andrew, give us an update on what's happening here at home.
Awesome. Thank you, Ben. Thank you, Tom. Thank you, Sam. We really appreciate it. A couple things coming your way schedule-wise. On May 18th at 5 p.m., we are going to do an investment pitch show. So we've done something similar in the past. Some people in the call have actually witnessed this firsthand. But essentially what we're going to do is have various members of our investment committee, both portfolio managers and analysts, come on and spend about 10 minutes each pitching an individual stock that they think is an attractive investment opportunity over the next 12 months. So it'll move relatively quickly, but you can hear some of our ideas and kind of get a little bit more of a behind the curtain look at the types of things we're looking at. So that's going to be May 18th at 5 p.m. We will send out invites. We'll also post that on the blog. It'll be over Zoom, so everybody can check that out. As a reminder, every morning at 8:30 in the morning, we're still doing our morning market briefings. We try to curate the news to really pay attention to what matters most. When earnings season rolls around, we pay a lot of attention to the results of companies that we hold widely across client portfolios. So it's a great way to stay up to speed, not only with what's happening in the market as a whole, but also in client portfolios. So if you want to join those calls, you can go to narwhalcapital.com/briefings and get there. I would also encourage everybody to check out the blog. We've been really pushing that hard for the last 6 months or so. Luke Burton and John Grayson have done a great job with content there. We're covering everything from personal finance to book reviews, things like that. So check out the blog. We'll also have the video of this presentation saved there in the next day or so. So if you want to check this out and rewatch it over and over and over again, I'm sure you'll want to, you'll be able to access that there. We've got 2 new employees here. Natalie Rogers joined us this week as executive assistant. She is going to be helping out a lot kind of on office administration. We're really excited to have her with us, and she's also going to be helping us just kind of enhance our engagement with clients and kind of streamline some of our processes. Don Scola joined us about 6 weeks ago. He's a CPA with about 10 years of tax prep experience. So he's working closely with Dean Wardlaw, Jonathan McKay, Sylvia Priest, the rest of our tax and trust department. So we're excited to have him on here. If you're a tax client, you'll probably be getting to know Don a little bit during tax season. And I know he's very happy that the deadline's been delayed. All our accountants are. In the news, we don't like to brag on ourselves too much, but we were recently named one of the 25 fastest growing investment advisors in the country. We don't really know how that happened. We didn't submit a survey or anything like that, but we came in number 25. Fastest growing firm in the Southeast. So we're really grateful for you all on this call. We appreciate you being here. We don't do a whole lot of marketing or advertising. We're pretty much a word of mouth growth strategy here. So we appreciate you all for your engagement. We hope that you're having a pleasant experience. If there's any way that we can be improving that, don't hesitate to reach out. But we really are so grateful to work with so many good clients. I'll wrap up. We've got one question. Only question we got from the field was essentially, why is there such a dispersion in the UK between the share of the population that is fully vaccinated and the share of the population that's had 1 dose of their shot? So for context, the UK is sitting at only 7.9% fully vaccinated, 46.4% fully vaccinated. So 7.9 fully, 46.4 partially vaccinated. So a big dispersion there. The biggest reason is in the UK, they are exclusively using AstraZeneca. They're putting a huge premium on making sure as many people as possible can at least get that first dose and get the benefit tied there too. With all of these vaccines, there's some benefit in terms of reducing the spread of COVID, even with that first shot. And specifically with AstraZeneca, there was a report put out by the Lancet in March that noted that with AstraZeneca specifically, the optimal time to be getting your second dose is about 12 weeks after your first. So a little bit longer lag time. It was proven to be significantly more effective in terms of the residual impact of that second shot if you went a little bit further out. So that's really the difference there. They're getting one type of vaccine and one type only. And on those, they're really trying to wait about 3 months before they do the second shot. So that will wrap it up. We, as always, appreciate you guys for being here. If you have any questions specific to you or just topics you think would be noteworthy to address, let us know. A lot of times we get questions off our morning market calls, things like that, and we actually turn them into a blog post for public consumption. So if you have any thoughts or any questions, any ideas that come to mind, please let us know. But once again, I'll wrap it up by just saying thank you. We appreciate you being here. We really love the engagement and hope this was useful to you. With that, we'll wrap it up. Hope you guys have a great day.